welcome attendees. We are getting up and running and we will get started shortly.
So is it okay if I go ahead and screen share right now?
You certainly can do that, Stan. That would be great.
Can you see my screen?
I can, yes. It's very
And my
full.
cursor's moving.
I can see your cursor.
Thank you.
Absolutely. And I'm still getting us connected to Facebook Live. Just be a moment. All right, and Stan, we're connected to Facebook Live, but I'm going to give us just another moment for attendees to join us and folks to tune in live, if that sounds good to you.
That sounds great.
Okay, great. All right, I just dropped a note in the Facebook comments there that folks can chat questions at us. A little housekeeping for those of you in the Zoom workshop. Welcome, thanks for joining us. You can hover over your screen and you'll see buttons for both chat and a Q&A button. You can use either of those to drop a question or comment to us, and we'll see it and make sure questions get answered and everything. And we are broadcasting live to Facebook. Nobody's watching us quite yet, but folks will be able to chat questions in there as well. All right, and Stan, what do you think about getting started?
Sure, that sounds great.
Great, let me, I'll just introduce us as a program really quick. So we are Fix-A-Fair at home. Thank you for joining us. Fix-A-Fair is normally an in-person series of events that happen throughout the year through City of Portland, Oregon. My name is Wing. I'm one of the coordinators of the Fix-A-Fairs. And we are bringing you our offerings live at home during the pandemic. And today we have a volunteer with Financial Beginnings. Stan, thank you so much for joining us today. Please take it away.
Thanks so much, Wing. It's a pleasure to be here and welcome everyone. As Wing mentioned, I'm with a volunteer with Financial Beginnings. We bring financial education programs to the community and schools. I want to encourage anyone who's watching today to go ahead and ask questions via the chat or Q&A button. Wing will will interject those questions to me, and I'd be happy to answer anything that you may have on the questions you have that are prompted by this presentation. Our topic today is managing debt. Debt is one of those things that we all deal with, we've all heard about, and so it's important to be able to manage debt. Now, before we get started, though, I wanted to do a little pop quiz and have you take a look at the screen and see these 6 individuals. First of all, the first question is, do you know who they are? And some of these classes, people don't know that who they are, so I'm going to help you. And then what do they all have in common? So just to give you a hint, this is Dennis Rodman. Dennis Rodman was on multiple NBA championship teams with Michael Jordan. This is rapper 50 Cent, actor Drake, longtime country and western singer Willie Nelson, Walt Disney, the founder of the Disney Corporation and Disneyland and Disney World. And this is Mike Tyson. Mike Tyson's won multiple heavyweight championships. Now, what do they all have in common? Well, there are 2 things. One is they're all famous or have been famous at one point in time and made a lot of money. And 2, they've all filed for bankruptcy. So by filing for bankruptcy, what that means is they had more debts than assets or ability to repay. And that's not a good thing. So debt can attack people that are famous and make a lot of money, and it can be a challenge for us as well. So what we're going to talk about today is we're going to look at why we go into debt. We're going to look at the cost of debt, and we're going to explore different ways to manage debt. And again, I encourage your questions. So first, why do we go into debt? Well, first, let's talk about the income side, because that bankruptcy scenario we mentioned at the beginning was really tied to 2 things. One is income did not exceed the debt that the person accumulated. Well, if you look and try to answer the question, how much will you make in your lifetime? Well, if you take an average of somewhere between $22.50 an hour to $30 an hour, you're going to make on average $45,000 to $60,000 a year. And if you average that over 40 years, you're going to earn somewhere between $1.8 million and $2.4 million. And yet, half of all Americans die with less than $10,000. So the question that raises is, where do our millions go? Well, here's an example of the kinds of things you can spend money on and over your lifetime. You know, to $250,000 on food. Housing is obviously one of your largest expenses. Interest payments. Now, a lot of this is tied back to your housing, but it can be tied to other debt as well. Retirement, taxes, government's going to get their share, which is a good thing. They provide good services for that. And that doesn't even count things like vacation, braces, and clothing. So what I'm also saying here is life can be expensive. And so as we look at these expenses that we run into in life, sometimes we need to go into debt. Now, credit is a term that's utilized associated with debt. And credit is the ability to borrow money, okay? Credit, it's both the ability to borrow money and there's a rating of credit. And that's oftentimes called your credit score. So why do we need credit? Well, sometimes that credit score or that measurement of credit, or sometimes called credit worthiness, impacts your ability to borrow, and in particular, the cost to borrow. So if your credit score goes down, the cost of a loan goes up. And that's just the natural reality of what goes on in the marketplace today, as you're out buying a new car, buying a home, or other types. Credit's also important for other things like your car insurance. Your credit score now impacts your car insurance. The lower your credit score, the more it may increase your car insurance rates, or sometimes your ability to get a job. So credit is important. You need to pay attention to your credit worthiness, and your credit score. And how to measure your credit score, there's another webinar that Fix-It Fair has put on. You can find on Facebook that goes into a lot more detail on credit and measuring credit score and improving your credit score. But today, what we're going to talk about is the debt side. What happens when you utilize your credit and take out debt? Well, is debt a bad thing? There are advantages and disadvantages to taking on debt. Some of the advantages are you're able to buy something now and pay for it, spread out the payments over time. There also may be some tax advantages to debt. For example, mortgage interest may be deductible for you. The disadvantages is you're paying interest. Interest is that fee that the lender is charging you for extending credit. That's how they make their money. Your debt may be tied to collateral, so that if you don't make your debt payments, you could lose your collateral. For example, a car loan. The car is the collateral or the asset that's pledged for that debt. In a mortgage situation, the house is the collateral. And so if you don't make your mortgage payments, the lender may foreclose on your home. A disadvantage is that your debt does decrease your net worth, but if used in the right way, that's okay. That's in and of itself not necessarily bad. But the biggest disadvantage of debt is that it can easily get out of control. And if debt gets out of control, then it can really become a problem. And that's where those people at the beginning we talked about, their debt got out of control. Now, the biggest advantage of going into debt is the leverage that it can provide. For example, by going into debt and taking out a mortgage, you may be able to leverage yourself into a nicer home living situation. By taking on some college debt and getting a degree, you may be able to leverage or improve your ability to make more money. And so debt can be a good lever as long as it's under control and tied to the goals, the specific goals that you're outlining for your life. Let's talk a little bit about goals, and in particular, financial goals. Goals can be divided into three categories. Long-term goals, like retirement. Everybody watching this at some point is most likely going to retire. If you have children or if you're thinking about going to college, long-term goal might be saving for college or buying a home. An intermediate term goal, something in the next 3 to 12 months, may be, again, buying a home, getting married, buying a car. So that can be a goal that you're outlining for yourself that you want to work towards. And short term, 1 to 3 months might be a vacation. You might be really needing a new smartphone, or you've got a special someone and a gift that's coming up. Those are all examples of the kinds of financial goals that you can outline and start working towards from a financial standpoint. Now, as you're outlining goals, what's important is to make them SMART. And SMART in this case is an acronym. And the acronym stands for specific, measurable, attainable, relevant, and time-based. So specific. What am I trying to achieve? Okay, and why is this important? Measurable, how much, how many, how will I know when it's done? Attainable, is it something I can actually do? Relevant, is it something I really want? And time-based, by what date must this goal be reached? Now, let me give you an example. You could set out a goal that says, I want to buy a house. I want to buy a home. That's not a SMART goal. It's too vague, all right? Now, you could turn that into a SMART goal by saying, I want to save $225,000 in the next year so I can buy a $250,000 home. Okay, now it's specific. I've got $25,000 is my goal. It's measurable. It's $25,000, a little over $2,000 a month. It's attainable. Well, that will depend on your individual situation, but if you set that as a goal and work out how you can set aside that kind of money, and maybe it's over 2 years, maybe it's $1,000 over 2 years, $1,000 a month. Is it relevant? Well, is it something I really want? Yes, I want to move into a new home. I want to buy a home. I want to build some equity. I want to have something. And it's time-based. I've set a goal for myself. It's either 12, 18, 24 months. The time frame doesn't matter as long as you've outlined what that time frame is. So why we go into debt? We go into debt because sometimes we need the leverage. There are other reasons we may go into debt that we'll talk about in a minute. But the way to do it smartly is to use SMART financial goals. Make sure it's part of your plan where you've outlined goals that are specific, measurable, attainable, relevant, and time-based. Now, if you are going to go into debt, let's make sure we understand what the cost of debt is. Well, as I mentioned earlier, debt comes with interest. Interest is the cost to borrow, the cost in money to borrow. Interest is always reported as an annual percentage rate. This is something our country did a number of years ago to make it easy to compare debt from different sources. And so everyone that you're going to borrow from will express that debt in terms of an APR, or an annual percentage rate. Now, how often it's compounded, and by compounded, I mean magnified or calculated, can be different by loans. The two most common are monthly compounding or daily compounding. So in a monthly compounding, let's say your interest rate is 12% APR and it's compounded monthly. That means we're going to take that 12% and divide it by 12 months. And every month I'm going to get charged 1%. And that's going to then get added to my balance. And that's the interest I owe and that I'll either pay or I'll get added to my balance. If I'm compounded daily, then I take that 12% divided by 365 and it's 0.03%. Or if you're doing the math, it would be 0.003 times my balance, and that will get added every day. Okay? Now, the thing to understand when you look at compounding is, take a look at this quote that is attributed to Albert Einstein. Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. So the same compounding effect will impact your savings and your investments. If you're being paid a dividend or any kind of interest on those investments, that same compounding will occur. But what you need to be aware of is if you're in a daily compounding environment and you're not paying that off on a regular basis, your balance is going to grow quite dramatically. And we'll give you an example of that here in just a few minutes. So understand the cost of debt is interest and how it's added to the loan. Now let's give you an example. Did you know, for example, that the interest paid at the beginning of the loan is more than is at the end of the loan? And here's one example. Let's say you take out a $20,000 car loan at 10%. The lighter purple box is the interest paid. The darker box is the principal, or the amount that you borrowed. The principal is the actual funds you borrowed. So that's this purple box represents the $20,000 being paid back over time, and the light purple is the interest being paid. Well, you can see in year one, interest and principal are almost equal, okay? Whereas in year 6, that it's not. Now, there's two reasons for this. One is the math, as they're calculating the interest. Your balance is larger here, so the calculation of the interest is larger. And two, the lender wants to make sure they get their money sooner rather than later. So that's an example where you're almost 50-50 in terms of interest versus principal. But let's take a look at a mortgage loan. So let's say you took out a $200,000 mortgage. You bought a $220,000 home, you put $20,000 down, so you've got a mortgage of $200,000. In the early part, these are years, so it's a 30-year loan. In the early part of your loan, almost all of your payment is interest. In the latter part of your loan, almost all of your payment is principal. Okay, and again, this is the lender saying the way they calculate interest, something called the Rule of 78, that they are getting their interest up front. You can see in this case in a mortgage loan where your interest is actually greater than the principal paid. So you took out a $200,000 loan and you're going to pay $231,000 in interest. Now with a lower interest rate, this number will go down. And I'm not here to say what interest rate you should or shouldn't borrow at. You should borrow at whatever interest rate you can afford. and a mortgage broker or a banker can help you with that. But understand that in the early stages of a loan, you're paying mostly interest. Okay. Now, the most common area that you could incur debt is with a credit card. Excuse me one second.
And Stan, while you're having a little break, we did have some attendees join us after my sort of housekeeping spiel, and I want folks to know if they hover over the screen, they can see the Q&A and chat buttons. And if you do have questions, feel free to just type those in and we'll make sure they get answered. Thanks, Stan.
Thanks, Wing. Appreciate that. So let's talk a little bit about the credit card cycle. There really is a defined cycle when you go through credit cards. The first is finding the right card. Now, I have people ask me, so how do I find the right card? And typically my answer is find the one with no annual fee. Okay. If you can find a card with no annual fee, then that's good, because I'm not a fan of paying fees you don't have to pay. That's just money out of your pocket. So people look for, well, what about a mileage card? Well, if you take out a mileage card, you've got to spend $40,000 to get a free ticket, maybe $20,000, but that's going to take a while to build that up. And that free ticket then there's some limits to it. And in the meantime, you're paying $75, $90 a year for that card. So depending on where you're at in your financial situation, my general recommendation is buy a card with no annual fee. Second, look for a card with the low APR or low interest rate. Now, the little secret in credit cards is if you pay off your balance every month, you never pay any interest. So if you're paying off your card every month, the APR isn't as important. Third, look for one with low late payment fees. And again, if you're paying on time every month, even if you're paying something less than full balance, you're never going to incur a late payment fee. So if you're making the right payments in the right time, then these don't matter. One of the other things to look for is instead of looking for miles, look for cashback cards. Cards that will pay you money back for using the card, because the credit card company is charging the vendor. That's the other place they make their money, is when you go to Costco and use the card is actually charging Costco. Or if you go to a department store, the department store is paying anywhere from a 1.5% to 3% fee for that transaction, for them providing you the ability to pay with a credit card. So find one that is going to give you cash back. So that's the first step, finding the right card. The second step in the cycle is using it. So there's something called the balance ratio. And that is, what's the balance between what you're spending versus your credit limit? So if you have a $500 credit limit and you're spending $400 a month, you're using 80% of your limit. Okay, 400 over 500 is 80%. And if you're using 80%, that's going to decrease your credit score. Whereas if you're running a $100 balance on a $500 limit, you're spending 20%. So your balance ratio is lower. Okay. So if you can keep your balance, and that will lower your credit score. So if you can keep your balance ratio lower, then that's going to help your credit score, and it's going to make sure you don't get in trouble by going over your credit limit. One of the ways to do that, also to use your card, is to use it to pay things like your monthly membership and monthly subscriptions. So you're using it on a regular basis, but you're not using the full credit amount. So set up auto bill pay. If you're sometimes get sidetracked and don't make the payments on time, now you're going to incur a late payment fee. That's going to impact your credit score, and you're going to pay an extra fee. On one of my credit cards, the late payment fee is actually $39. And if I'm late more than once, it can take my interest rate to 29, almost 30%. So paying on time is important. And setting up auto bill pay is a good thing to do. So paying it every month, okay, you want to pay it by the due date. And we're going to talk a little bit about minimum versus full amounts. And if you could set up minimum payment, automatic payments, that's going to help you. Okay. The last step is maintaining it. Periodically do a credit check. If you didn't attend the credit webinar that was held by Fix It Fair, you can go to Credit Karma with a K, KARMA.com, and you can check your credit score for free. And if you do go to Credit Karma, do not sign up for the paid version. You can sign up and open a free Credit Karma account, and they'll provide a little bit of monitoring as well. So do some credit checks periodically. Ask for a balance increase. So if you can increase your balance, and it can help your balance ratio. Ask for a lower APR, just in case you have to pay interest if you can't pay it off in full. And recognize that your credit card can be closed by the creditor if you go for an extended period without use or an extended period without payment. And so they have the right, and that's part of signing up for the credit card, to actually close your account. So that's the credit card cycle. Find the right card, use it, pay it. This is the most important component. We'll talk about that in a minute. And maintain it. Okay? Now, let's look at credit card payments, full balance versus minimum payments. Now, normally in a webinar, I'd show this video. This is a YouTube video. I can put this in the chat box. We may be able to grab that and chat it out to you. But I'm going to tell you what that video covers. It's a 3-minute video that talks about what happens if you only make minimum payments. Okay, there's a specific scenario, and the title of this is how minimum payments won't get you out of credit card debt very fast. Let's assume you have a credit card and you run up $10,000 worth of debt on that credit card. And then you stop using the credit card. You cut it up and never use it again. But you've got this $10,000 worth of debt, okay? And let's assume this is at 14% interest, 17% interest, which is a pretty common credit card amount. Then you're going to have minimum monthly payments of $142. Now you say, okay, I'm going to make minimum payments on that $10,000 worth of debt. So I make a payment month one of $142. So my balance has gone down to $9,858. But then interest is added, that compounding of interest. And so at 17%, we're going to add back in interest, and now my balance has gone back up to $9,999. So after month one, I've made $142 in payments, but my balance has only gone down by $1. So $141 was towards interest. Okay, so that's month one. I'm going to do the same thing month two. I'm going to make a payment in the amount of $142. And now my debt's gone down by $2 because I've paid down the 142, but interest's been added back in. So my debt's gone down by $2. After a year, I paid $1,846, but my balance has only gone down by $5. I still owe $9,995. After 2 years, I've gone down by $10 and I paid $3,500. After 5 years, I paid $8,600, almost $8,700, but I still owe over $9,900. After 35 years, the debt, we start to make it, we make a debt and a debt, and I paid almost $60,000, but I still owe $1,300 on that debt. And after 36 years, I will have paid a total of $61,060 to pay off that $10,000 in debt. Now think about over 36 years, $51,000 that you've paid in interest. And the reason is because you've only paid the minimum payment. Okay, so what's important here is to recognize that if you're going to put something on your credit card, have a plan, ideally to pay it off the next month, and therefore you'd pay no interest, or to pay it off as soon as possible and make more than the minimum payments. So when you get your credit card bill, you know you can pay minimum, You know you can pay the full amount, and you can pay anything in between. Now, let's say we get into that situation where I just can't pay. Debt's overwhelming. It's like those people at the beginning. The most important thing you want to do is stay in contact with your creditors, particularly in this time. One of the things that I do in addition to volunteering with Financial Beginnings is I do financial coaching. I coach people, and I've got a client right now that during COVID, her business went out of business, but she still had some loans, rent, expenses. And so we worked through a process where keeping in touch with creditors, okay? Staying in touch with people so that they know, and these creditors know COVID's impacted everyone, and let them know that I'm working on it. I've got a plan, and look for ways to settle. There are ways to settle debts with creditors. If you need to, find credit counseling. Go into credit counseling to look at how you break that cycle of continuing to add to your debt. Recognize that negative marks are going to show on your credit for 7 to 10 years, and bankruptcy really needs to be the last resort. And there are 4 types of debt that cannot be discharged in bankruptcy. They are taxes, alimony, child support, and one of the things that's near and dear to my heart in this next topic, and that's student loans. So those 4 items cannot be discharged or erased in a bankruptcy. If you have those debts, you need to figure out a way to pay them, and that's where credit counseling can help. Student loans. There are over $1.4 trillion of student loans in the United States today. Okay. And so in fact, this is an interesting statistic. More students drop out of school because of financial troubles than academic troubles. So a rule of thumb when it comes to student loan debt is that you really shouldn't graduate with any more debt than you have your first year of salary and your expected job that you're going to land. So let's say you're going to school to be a teacher, and let's say the teacher makes first year out of school somewhere around $45,000. I don't know if that's true or not, but I'm just using that as an example. Then you shouldn't graduate from college with any more than $45,000 in debt, okay, over 4 years. The list price to go to the University of Oregon is about housing and tuition is about $17,000 a year. So that is $68,000 over 4 years. So if you're going to graduate with $45,000 or less, you got to find a way to make up the difference. Now, a couple of strategies to figure out how to do that. First is look for student scholarships. Look for grants. There are a ton of them. There's another webinar that is that will touch on that. The other is consider community college. Community colleges are one of America's best kept secrets, okay? Particularly for your first 2 years. If you're gonna go back to school, a community college is a wealth of educational resource taught by professionals and professional educators and professionals from the field, and much less expensive than going to what I call a sleepaway college. So keep that in mind as you look at student loans and student loan debt. So the moral of this part of the presentation is that if you have large loan and credit card payments, it's going to make it difficult to reach your financial goals. So keep those under control. Make sure you're working towards your financial goals. Make sure you're managing your debt. Which leads us to our next topic. How do we manage debt? Well, there's really 3 ways to manage debt. The first is to create a budget. The second is having an emergency fund. And the third is deferred spending. So let's talk about that. Has anybody out there ever created a budget? Now, you may, and feel free to type in the chat if you have created a budget. You may have created a budget without realizing you created a budget. If you did planning for college or for a wedding, or if you did planning for moving or a rent increase, or a new baby, or a job change or a vacation. Those are a budget is where I'm going to outline money to cover an expense. So the basics of a budget is, let's look at income minus expenses equals our net income or net loss, our surplus or our shortfall. Okay. And ideally, this needs to be 0 or positive so that income is greater than expense, or at least equal to expense. Now, income can mostly come from earned from your job, whatever work you do. It may come from your portfolio. There may be investment income or dividend income or things of that nature, or it may be gifted or borrowed. Okay. But if you're borrowing money, then your expenses, that loan payment's also going to show up in your expense. Expenses can be broken down into these two categories, fixed and variable. Fixed expenses are things that you know about and are typically the same amount every month. So your rent is typically the same every month, or your mortgage payment. Your car insurance is the same every month or every 6 months, depending on how often you're paying that. Most loan payments are broken out on a monthly basis. Now I'm going to say not credit card, but loan payments. And your phone bill is typically the same amount, particularly these days. Variable expenses are things that can vary by the month. If you drive more, you could spend more on gas. If you eat out more, your food budget may go up. Entertaining may go up. So these are variable and can vary on a month-by-month basis. So again, how to start the budget? Choose a time period. Typically, most people look at either monthly or twice a month. They look at their pay period. Okay, how often do you get paid? And that's usually a good way to look at it. Monthly is good because your fixed expenses are typically on a monthly basis. But you can take your cell phone bill and divide it into 2 and know that you need to set aside half of that $100 a month you have for your phone or cable bill every month, and set that aside out of each paycheck. So project your income and expenses, calculate this ratio, and income needs to exceed expenses. And then go find a worksheet. There are a dozen of them on the web. If you just type in budget worksheet example, you can find a worksheet, and it'll outline a whole bunch of categories that then you can look at and say, this is on a monthly, weekly, biweekly. Again, put your time frame in here and write this out. Either do this online or print this out and write this out. What's my salary? Okay, what am I going to make? What's my house, my rent or mortgage and utilities? And if you own a home, what am I setting aside money for property taxes and non-housing and all that sort of thing? And savings. Put savings into your budget. Okay, and that's how you're going to meet your financial goals. Now, here's one rule of thumb that you can set up when you look at your budget, and that's called the 50-30-20 budget. The 50-30-20 budget is looking at 50% towards needs. Okay, the needs are things you need food, you need a place to live. It'd be nice to have electricity. You may need a car to get to your work. Health insurance is very important and very available and widely affordable today based on your income. Okay, healthcare.gov is a great resource. I was talking to them earlier today, and they're open 7/24. You can call, and people are tremendously helpful. The 30 is towards wants. Just because you have a budget doesn't mean you can't shop out or dine out or have hobbies. It means you need to allocate the money for those and stay within that allocation based upon your income. And then 20% towards savings and debts. Okay. Now, if you're, so your debts, make sure you get those paid off, and then start saving towards your short-term, intermediate, and long-term goals. Now, let's say your debts are a little bit out of control and you want to really work on knocking down your debts. Then I would reverse these two, and I would make this 50, 20, and 30%. So 30% of your income should go towards debts and savings to get your debts paid down, get that credit card paid off, get that car loan paid off, and start saving. Okay, so this is just a rule of thumb or a guideline. 50% towards needs, 30% towards wants, 20% towards savings and debts. Now, what busts our budget? Well, things like unexpected expenses. Unexpected expenses can be, I have a car accident and I've got a deductible I've got to pay. And I generally haven't budgeted for a deductible, a $500 deductible on, I had a mistake, life happens. Unexpected expense could be a healthcare expense, or the brakes go out of my car, or something along that line. Okay, I've got a home repair that's not covered by my homeowner's insurance or something like that. Unrealistic budget line items can bust my budget. An unrealistic budget line item can be, for me, if I say I'm going to eat out and I'm only going to spend $5 a week on eating out. Well, that's a small meal at McDonald's, and I know that's not something I can do, I'm going to do. So unrealistic budget line items. Lack of necessary adjustments. So you're going to adjust your budget every month. We'll chat about that in a second, but you got to adjust and figure out that I'm not able to get by on $50 a month in gas. It really is $75 a month in gas. And so I need to adjust my budget and take that $25 out of something else. Not following your budget. Okay. So if I've allocated, let's say I've allocated $25 a week to eating out, or $100 a month to eating out, and I go out this week and spend $50. That means next week I can't go out at all. Okay. So not following my budget, then that's going to bust my budget. That's going to make it hard to meet, have expenses meet income. And not including what if scenarios. And that's all of these that could come into play. So those are just some examples of what can get in the way of your budget. So if you set your budget, okay, develop a plan to review and implement your budget. So there's two types of budgets: under construction and out of date. Okay, your budget is not going to be exact. Don't expect it to be exact. All right. So plan to have a little less expense than income, so that you're going to go over a little bit, and you're okay with that. But the most important thing is to make adjustments. Okay, set a plan to review your budget every month. Okay, just sit down, take a look, and say, how do I review this? Now, you may be thinking to yourself, this is a lot of work. Well, there are tools. There are a variety of tools that you can use to keep track of your money. You can go old school and use your check register or pencil and paper and a calculator. You can use Excel, okay, and either key the information in or download it from your bank and your credit card company. Your bank may offer an app that you can use, or you can use an external app like Mint. This is not an advertisement, but recently I've started using Mint, and I find there's a free version, and you can tell I like free versions. I don't like paying fees. I don't have to pay. And so that's a really, really good tool. Which budgeting tool is best? The one that you'll actually use. So it doesn't matter which one, as long as you'll use it. Now, the second tool is an emergency fund. And what an emergency fund is it is 3 to 6 months of savings set aside for some of those unexpected expenses. So your first savings goal ought to be to get this emergency fund in place. So if you do have an unexpected accident and you have to pay a deductible on your insurance, you have it in your emergency fund. If you have to replace the brakes on your car, you have it in your emergency fund. Getting a new cell phone because you want the latest cell phone, that's not an emergency. That's a want, and you need to budget for that. A job loss. If you have 3 to 6 months of 3 to 6 months of your income, 3 to 6 months of income, a savings set aside, okay, then that will cover you on a job loss in case it takes you a while to get another job. The third category for managing debt is deferred spending. And you really need to look at needs versus wants. Money is very emotional, and it's easy to get caught up in a moment that I really need this. Now, you may have seen me earlier. I picked up my coffee. Okay. Now, I could get coffee in the morning. I had an appointment before this morning, so I went through McDonald's drive-thru, and that's $1. Or I could go get a latte at Starbucks and pay $3. The latte at Starbucks is a want. Having my morning coffee is a need. I need that. Okay. But that's the difference between a want and a need. Okay. Having a fancy car, that's a want. Having a car is a need. Okay. So it's important to take a look at all of your expenses, and as you're spending money, determine if it's a want or a need. There are a couple of tools to do that. One is to ask yourself, when you're looking at purchases, what will this be worth to me in 10 minutes, 10 months, or 10 years? Okay. So that latte in 10 minutes might be worth to me, but in 10 months, I'm not going to remember it. So maybe that's a want, not a need. I can also let things sit in my shopping cart overnight, or for 1 hour, overnight, or for 24 hours. And that'll help me evaluate, do I really, really need this? Or is it just a want? Okay, so that's one of the ways to look at deferred spending. So now what? To wrap this all up in managing debt, the first recommendation is set smart financial goals. Okay, remember SMART: specific, measurable, attainable, relevant, and time-based. Next, develop a budget. Okay, have a budget. Recognize that you're going to have to adjust that budget every month. You're not going to be exact. Don't beat yourself up if you're not. Just make adjustments to it. Create an emergency fund. Okay, highly important. 3 to 6 months worth of income set aside so that you can cover those emergencies. Life happens. Nobody can plan for everything that's going to happen. So, but if you have that emergency fund set aside, you're covered. Okay, minimize your debt accumulation. You can see how you build up debt. Our example of making minimum payments, taking out a car loan, student loans, credit card loans. You start to add all that up, and pretty soon you're like Walt Disney and you have way too much debt, or Willie Nelson, and you have way too much debt and you can't pay it back and you have to file bankruptcy, which is also expensive. So minimize that debt accumulation. And then understand needs versus wants. One of the things I've said often is you can make $1 million a year, but if you spend $1.1 million, you're going to go broke. So, and those people at the beginning gave us an example of that. There are a lot of pro athletes that are examples of that. So understand needs versus wants. Cover your needs, allocate for your wants, but make sure they're built into your budget. And so if you look at that, if you understand the cost, why we go into debt, what the cost of debt is, and figure out how to manage your debt, then you're going to be able to meet your goals, and you're going to take away one of life's stressors, because money can be a stressor. And if you can take away some of that stress, then life's going to be a lot better. Hopefully that's the presentation that we have for you today. Hopefully there was some nuggets of value in there for you. Wing?
Thank you so much, Stan. I want to acknowledge just a comment that popped up a little bit ago. I think you covered it, but an attendee says there are also many budgeting apps that you can enter your expenses as you go. And I think Mint is one of those that you mentioned. Cool. Just wanted to make sure that was out there.
Many of those on the web, and most of them offer a free version. I'd start with that and find if it's something you can use before you pay an annual fee. And then if it is, go for it. And then, but again, make sure you build that annual fee into your budget. But yeah, there are many apps out there that you can use, and it just helps, makes life a lot easier. Thanks, Wee.
Yeah, thank you. And, I'll say I noticed a few attendees came in a little late. And if you want to go back and watch this recording immediately, I'm going to drop a link to our Facebook recorded videos we're live on Facebook right now, but the recording pops up in our video area within a few minutes after we're done. So if you did want to go back, rewatch the beginning, I know there were a lot of resources that popped up. So if you do want to go back and check those out, I actually did a screen grab for myself of the budget worksheet, Stan, so that I can go back and reference that myself.
Absolutely.
And we have a thank you from one of the attendees in the chat. And if folks do have questions, let's see, I have one pop up right now. We do have a little bit more time so folks can enter questions in the chat or Q&A. And so a question that we have is it worth meeting with a financial advisor, and what do they generally cost? That's a great question.
So I'm going to give you the middle of the road answer. It depends, right? But I'm going to tell you what it depends upon. Financial advisors, first of all, are paid one of two ways. They're either paid on a fee basis or they're paid as a percent of assets that they manage. So if your goal is to get your budget under control, then I wouldn't necessarily meet with a financial advisor. I'd find somebody in the credit counseling world. Start with your bank or start with a community college. Okay, are two resources to look to. Financial advisors are going to help you get a handle on taxes and investments and college loan strategies and Social Security strategies, and that can be phase two. Phase one, if you're getting your budget together, then I would meet with a credit counselor. And I couldn't tell you what they'll charge, but I know if you go to your bank, it may not be all that much, and a community college may not be that much. So hopefully that answers your question.
And we got a thanks from that attendee. So Stan, thank you so much. This was incredible. This was so valuable. I really appreciate you being here today, presenting all of these amazing resources. I dropped some links in our email address if folks do have questions afterwards or looking for some of the additional resources that Stan mentioned as well in the presentation. You can find us there. Stan, thank you once again.
It's been a pleasure, Wing. I think that this is such a vitally important topic, and I'm just really pleased to be able to share a little bit with you and your audience. So thanks so much.
Yeah, thank you. And we'll talk again soon. Thank you, everybody, for tuning in, attending. Bye for now.
Bye-bye.